what we do in this paper is that we analyze how do investors value weather and how do investors value CSR. And we do that in an experimental context. If we think of CSR, we think of firm's action that the firm aims to do good. For example, it aims to improve its environmental performance, it aims to improve its social performance, going beyond the legal standards. And there have been many, many papers that analyze whether it is doing good is actually financially viable. Huh? So will this be financially good for the firm as well, or maybe actually leads to more cost? And there have been many papers showing both sides. There have been many papers showing that it has no net effect. And ultimately, probably, it's a topic where you see that different policies of doing good will have different financial implications, and where you just would need to evaluate project by project. But so despite this fact that we see it's not clear that there's really a link between corporate social responsibility and financial performance in terms of profits, what we do observe there's been a huge increase in investor interest in sustainable investing. Yeah, so investors want to invest sustainably, despite the fact that it's not sure that they will earn any higher returns with that. Maybe there was some abnormal return potential in earlier years, with 50% of investors in Europe investing sustainably. Anything that might have been there at one point in time should have been priced in long ago. Yeah, similarly in the US, we see it's about 25% of investors investing sustainably, so we wouldn't expect any abnormal returns. Still, we see this huge interest in sustainable investing, huge interest in companies' corporate social responsibility performance. So basically, coming to the question is, do investors value corporate social responsibility without actually the financial implications? And that's why we choose an experimental approach in this paper, because we want to have the same financial payoffs, identical financial payoffs, and really be able to differentiate and say, okay, isolate corporate social responsibility and say, yes or no, people are willing or not willing to pay for corporate social responsibility. Yeah, so take the link to financial, or any potential link to financial performance away. In the experiments, we can keep the expectations on financial performance constant, right? We can say like, okay, this is the expected payoff, identical for all the different assets. Now, how much would you be willing to pay for an asset that's responsible versus a conventional asset? Yeah, so that's why we choose an experimental setup. And the other reason is that we want to study exogenous variation. Right, in practice, we of course see that companies, they may choose an environmental or social initiative because that's also profitable. Yeah, so there's some kind of endogeneity always in the choice between certain types of social performance, environmental performance, and financial performance. Here in the experiment, we can cause an exogenous variation that's otherwise unrelated, completely unrelated to the financial payoff. Yeah, that we can put in the experiment and we can take it away again without changing the financial situation. Okay. We take a typical experimental setup. We present assets as lotteries, as many other papers do, and these lotteries have identical expected financial payoffs. We're going to see on the next slide, they're also very easy. Payoffs, so we choose a very easy payoff structure so people should understand how they look like. We choose an initial public offering context. We do that so people see that they have impact. So what's happening in the experiment is that a student, or so investor, representatives, basically an individual, gets presented an asset, and only if the person pays a high enough price, this asset will actually be issued. Now, if the price that's the bid the person makes is not high enough, there will be no asset issuance. Yeah, so the bid the person makes directly has an impact on whether the asset is being issued. Okay? If the asset is issued, it might trigger a donation. The responsible assets, they trigger a donation. This donation we see as a metaphor for CSR. That is our CSR representation in our laboratory experiment. It's most closely, if you think of what type of CSR it is, it's most closely probably related to Benabo and Tirol, where you have this idea of delegated philanthropy. We have this asset, and this asset is additionally also doing something good on behalf of the investor who might or might not be willing to pay for that. Okay? We use 3 different NGOs as recipients of the donation. Here the idea is to reflect the ESG that we also see in practice. So we use one environmental, that's Greenpeace, one social, we use the Red Cross, and then we use to represent G, we use Transparency International. Yeah, so on the one hand, that's a bit of a reflection of the ESG paradigm we see. On the other hand, we also hope that we cover people's different preferences. Yeah, some people might care more about social causes, other people might care more about environmental causes. Okay? Then we vary the amount and the timing of the donation. Varying the amount can inform us about how people like CSR or donations as they increase. Yeah, so we have one setting where we have a smaller donation, one setting where we have a larger donation. And basically, if you're a person and you think of doing good, do you want to do a little bit good? If you're an investor, do you want to invest in a little bit responsible company, or do you want to invest in a lot responsible company? And are you then willing to pay a lot more for a lot very responsible company as opposed to a much less responsible company? Yeah, so more formally, basically, so does the utility of going good, the marginal one, change over the amount? Yeah, so do you really care a lot about doing a lot of good? Then we also look at the timing of the donation. Here we have different settings where sometimes the donation is coupled with a situation where the individual also has a gain, and at other times the donation is coupled with a situation where the individual does not have a gain. Okay? What's the idea of this is to look at CSR in different business cycles. Yeah, so do you want the firm to be just responsible if times are financially good, or do investors want the firm to be responsible all the time, or maybe even most responsible be in bad times? Yeah? In this experiment you're going to see on the next couple of slides, this would be independent of the own financial payoff. Yeah? So the situation is to look at, do you want a firm to do good in bad times, even if there is a zero net effect on the finances? Okay? Then we ask subjects to state their willingness to pay, and to make sure people also state their true willingness to pay, we use the Becker-de-Groot-Marschall mechanism. Yeah, and people know, so that they say the true price. That's the, with this mechanism, we're going to see in a couple of slides, that's the only optimal choice, basically. And I think what's also important to highlight is really only if people say the right price, high enough price, then only the asset is issued, and then only we will make a donation to one of the 3 charities. Yeah, so this money is actually being donated. Yeah, so people know that their price has an impact directly, basically with real money. Okay, so that it's not a hypothetical situation. And if they overbid, for instance, also with this mechanism, that would mean they would go home themselves with lower earnings. Yeah, or with less money. Okay, this is the experimental design. You see here, just above me, on the right-hand side, you see the, no, what? What's that? So, that's just above me, you see here the conventional asset. As I had mentioned already, we take a very simple structure. We have a 50% chance of having a financial payout of 100, 50% chance of having a financial payout of 0. Yeah, so everyone can easily say expected value of 50 years. Then you see our first responsible asset on the other side. Same financial payoff, right? 50% of 100, 50% of 0. But now we have a donation. Yeah? In each state, in the good state and in the bad state, we have a donation of 20 years. On the slide, it gives an example as the Red Cross, but this we have also Greenpeace in, right? And we have Transparency International. Every of the individuals gets always all 3 charities. Okay? So this is the first 2 assets we have. Then in assets 3 and 4, we look at good times versus bad times. You see asset 3 up here. We see in asset 3 up here the donation, the 0 donation in good times associated when there's the 100 payoff, and then there's there's a 40 donation in bad times. Yeah? You see, if you go back to compare to this slide, right? So the expected value of the donation with the basic asset we have is the same, right? Because it's 0.5 times 20. Yeah, and across all the assets, the financial payoff is the same. So this is what we see here, the asset with the donation in bad times, and we see here the asset with the donation in good times. So there's 0 donation here for asset 4 in bad times, and then there's a 40 euro donation for asset 4 in good times. Yeah, so here people, without having an impact on their own money, they can basically show in the bid they make whether they like giving more in good times and bad times. Yeah, for the firm on their behalf, and doesn't affect their own finances. So in principle, if you would have a person who would not have some kind of doing good component like we saw earlier in the utility function, it wouldn't matter to them, right? Then the last asset, asset 5 we look at, is an asset that we call it the high responsibility asset. So you see it has here a higher donation in both states of the world of 40. Yeah, so it allows us, when we compare this asset 5 to asset 2, yeah, so you see we double the donation. Yeah, so we can evaluate whether there's a larger difference between asset 1 and asset 2 versus asset 2 and asset 5. Yeah, so basically it's their increasing marginal utility to doing good. Okay. I had mentioned already we implement this whole setting as an IPO, right? Only if there's a high enough bid, then that asset is being issued. When our subjects, I think they get a 10 euro show-up fee, and then when they come in, they get additionally another 100 euros. I always say the experimental currency units, I use 100 euros because it's a one-to-one we do for 10% of the subjects that we pay out. And so it's the same. So subjects, they are endowed with these 100 euros, and then they make this bid. Oh, they state their willingness to pay B for the asset. And their willingness to pay, they can give between 0 and 100. And at the same time, we make an IPO price P. That's a randomly uniformly distributed price between 0 and 100. If the bid is higher than the price, the transaction is executed, right? If the bid is lower than the price, there's no asset issued, there's no payoff. Now, so it's always, if the price is high enough, there's a payoff in the donations. If the price is too low, there is no payoff, no donations. That's, in that sense, it's an IPO setting. Okay? We do this with 302 student subjects. We run actually 2 trials, or we ran a lot of mornings we did, but we did one group of 150 we did before Christmas, and one group of 150 we did after Christmas, so it's also not a Christmas effect. One is November, December, and the other one is January, February, when people are out of money. The results are relatively similar. Yeah, the one group has a quiz, the second group we had a quiz to get them even better understand it, but in the paper, basically you see all the different samples. Here I just have the results for the complete sample. Okay. We do 2 replications with each asset, so 2 replications with a conventional asset, and then also 2 replications for each responsible asset just to have more stability. But also we see here in the paper, you see tables where we have the different replications and the results don't vary across replications. Then we have here 24, right, because we have 4 responsible assets, and then we have, for each asset, we have 3 different charities. Okay, so the Red Cross, Greenpeace, and Transparency International. So each of these students faces twice each asset and all the 3 different charities. Okay, so when they're finished with all of that, like the quiz and the charities, and all the replications of the asset, then we often ask them a whole questionnaire of questions. Mainly about their personality traits, about demographics, political views, views on SRI, previous investment experience. Basically, we looked at a lot of the questionnaires of previous work and we took in most of the items in there. Okay? Okay. Using this data set, and in the paper we derived that more formally in a model, but here I just motivated a bit intuitively. Using this data set, we basically we're testing in the paper our model. And we have 3 main hypotheses. So the first hypothesis is that individuals will pay more for an asset with which they do good than for a conventional asset. And I think this is the most basic hypothesis. There's a lot of literature you can use, many survey studies and so on, that you can use to motivate hypothesis 1. I just give 3 examples here. Martin Moser is a paper that people are willing to show that people are willing to pay more for for firms that make green investments. I think many of you probably know Paul's paper from 2017 in the JF, which shows that people with pro-social preferences, or that's a motivator to invest socially responsible. And the last paper, the Bauer et al. 2019, we're going to see in turn, which shows that people have a preference for their pension, even for their pension money, to be invested sustainable. So I think there are many other, you could also argue coming from more the donations literature to support this hypothesis. Okay, so that's a basic one. And then we have hypothesis 2A and 2B. You see that go into opposite directions. Yeah, so with 2A is individuals are willing to pay more for a responsible asset in the bad state than in the good state. Yeah, so here this is the idea of emotional hedging. So if I'm already kind of in the bad state, at least maybe someone else benefits. Yeah, so it's kind of, I'm not feeling so well, I don't get any money, but I might still benefit from the idea that someone else is getting money by me buying the asset. And it doesn't cost me anything, right? It's not that further money is taken away from me. Remember here in the setting, the payoffs in the good state and bad state, the financial is always the same, yeah? So this is the idea of emotional hedging, which has been shown by Morwich et al. That's the one thing to say, like, okay, if I'm in a bad position, at least other people are benefiting, that also makes me happy. Then there's a large psychological literature that is then relating to 2B that shows that actually, indeed, people like to give if they are well off. Yeah, so they are starting from Eisen already in 1970, there have been many experiments in the psychology literature that show if that people get something, then they also like to give to someone else. If people experience a success, then they also like to give to someone else. So if I'm feeling good, or if I have a good situation, I face a good situation, I'm also happy if someone else is happy. Now that's the opposite. And you basically, based on there's probably more literature in the psychology literature actually for 2B. Yeah, but there's more which on emotional hedging. There's also some donation experiments which could support that. Yeah, so if you get more money, then you also give more money to someone else you're playing an experiment with in the game. Okay, but either way, you can argue both ways theoretically. Then going to hypothesis 3, that's about the asset 5 versus asset 2. So if people do good, do they want to do a lot of good? Yeah, where's this idea coming from? It's coming from what Oliveira et al. Call giving types. So what they, for instance, find is that people who give tend to give a lot and they tend to give again. Yeah, that's then the giving type of person. While other people, they don't give, they just don't give. Within their sample, at least, you see relatively few people giving a little bit. Either I give, then I give again, or I give a lot, or if I don't give, I don't give. And so indicating that there's this increasing marginal utility of giving. I want to do really a lot of good, or I just don't care. Okay. To test these hypotheses, we used the data that we gathered with the experiment. And these are the first univariate results simply shown here. You see here the premium, we start with the premium A2, right? So this is the difference between the bid on asset 1, the conventional asset, and the bid on asset 2, the first responsible asset. Remember, asset 2 was the asset that pays 20 euros in each state of the world. Okay? And what we see here, this asset is the little bit responsible asset, and what we see here, people really, this is 3 cents, right? In terms of economic magnitude, and the T statistic is virtually equal to 0. Yeah, so people don't pay any more money for the little responsible asset than for the conventional asset. Okay? Then we look at the premium to asset 3. Yeah, so remember, asset 3 was the asset that had the donation in the bad state. Yeah, so that's the premium, so it's the bid for the donation, asset that has the donation in the bad state minus the bid for the conventional asset. Okay? And what we see here is that people really don't want someone else to get something if they're themselves in a bad state. Now, I found this, for me, it was quite a significant result because remember, it doesn't affect people's own financial payoff. Yes, my anti-expectation would be that this coefficient would be equal to 0, this part would be equal to 0. Yeah, because at least I don't care for someone else getting something if I have nothing, if it doesn't cost me anything either. Yeah, so in that sense, I felt it was a very strong result to say, like, if I don't get anything, I don't want someone else to get anything, or I pay a lot less for such an asset, even if it doesn't cost me anything. Okay? People do really like to give if they themselves, or like an asset that has a donation, they're not giving their own money, they do like an asset with a donation if they themselves get money too. And see, this is the premium on A4, the asset with the donation in the high state, the good state. And here the premium on asset I5, so this is, remember, it's the asset with the 40-40 donation, the high donation. So what we really see here is that people are willing to pay a lot more for the high responsibility asset. If we compare that, you see the last one is the test of hypothesis 3, relating this, right, the high responsibility asset to the little bit responsibility asset or half as much responsibility asset, then we really see that if people give, they like to give a lot. Yeah? What we also see here is if you go to the second to last row, the premium A4, A3, right? That's this one minus that one. So also we see there's a huge difference between the asset that gives in the good state and the asset that gives in the bad state. Yeah, so what we can basically see is like if people want to give, they want to give a lot. In general, they like doing good. The asset that does good, but yeah, we did this also in a multivariate context with a lot of control variables. This page, next page, all control variables, many specifications. What you see, the main important control variable that came out again and again significant for our paper is the altruism scale of Schwartz. All the other stuff about religion and so on for us in our setting did not play a very big role for people. Huh? Okay. Yeah. So, just putting this together in a nutshell, we had this experience where assets were issued with varying CSR, and we had this incentive compatible measure, right, where the student subjects, relative to their other income that we learned, actually could earn quite sizable amounts of money. Yeah, so for students, you could get up to a few €100, so that was really money for them, relative to their regular monthly income. Okay? Given this incentive compatible measure, we found three main results. It seems that assets are valued with CSR, at least in our setting, were valued more. But going right to the third point, individuals seem to have this increasing marginal utility, right? So only if there's a lot of CSR that's valued a lot more, a little bit of doing good is not really something that people seem to care about or seem to be willing to pay for in our experiment. And what we also found is that CSR is valued more when its impact is pro-cyclical, right? People like to have the donation in the good state. They really dislike the donation in the bad state, even though it doesn't cost them anything. Then for this, maybe just to go one time, so you see this may be interesting to see. This is the asset in the bad state, right? That gives in the bad state. For very altruistic people, you see this is one standard deviation above the average altruism. It's a bit mitigated. Now that might be something, but in principle, most people don't like someone else getting something if they don't get something. And then this is robust to a ton of different specifications, samples, and so on. So yeah, thank you very much.